strange set of circumstances, I've become lost in the bowels of the FT building in central London. I'm Katie Martin and I'm joined by Laura Frost, who's an investment director at M&G. It's a very scary time of year and I don't know what we're going to find. Laura, come on. Who knows? Follow this mysterious red string. Okay. What's this chart? This is the Anaconda moment, and I guess the bit on this kind of snake type pattern that we're looking at here that's the most terrifying is this pickup at the end. This is the 30-year Treasury yield. So the yield's picking up, which means that prices are falling. Why is this happening and why do we need to be worried about this?
Absolutely. So the 30-year Treasuries have been kind of asleep for a decent amount of time. Obviously, this is a 30-year bull market. Now, there was a resistance level somewhere around 320, 325. We've popped through that resistance level. There were some technicals at the long end of the US curve. So that's obviously starting to roll off a little now, and that means that this Anaconda has begun to wake. Obviously, we've had 30 years of bomb prices going up. Is this the change in theme? Is this the change in mode? Is this the moment where the Anaconda wakes?
And one of the things that's really scaring investors at the moment is that fixed income market is selling off at the same time that the stock market is selling off, and so it's really difficult to hedge yourself against losses. Is that one of the things that you think will be one of the scarier formations, one of the scarier patterns towards the end of this year?
Well, this is frightening, isn't it? And you have to wonder whether the stock market is fearful of profits not being quite so good going forwards.
So, following this red string further, here's something that truly strikes fear in the heart of a lot of investors, is this curvelight phenomenon.
Yeah.
Explain to the uninitiated what this is and why it terrifies some people.
Covenants are legal agreements that tell you if you buy a bond at a certain point in the capital structure, how much protection you have in the event of default, in the event of that company moving into a distressed state. So curvelights are a lighter version of that basically allows distressed companies to continue to issue secured debt even when they are in a distressed state. Now, obviously, that then erodes value of the tiers above and essentially may, in the event of default, affect the recovery rate of that company as well.
So you're just losing your protections, you're losing your safety nets. And what we can see in this chart here is that the number of these types of deals has been picking up over the past sort of 5 years or so, and it's not tailing off now.
No, and I think that's partly due to the obviously great financial crisis. Yields are falling and clients are searching for yield.
Okay.
Hey, here we are.
Here we are. We're at a chart here that shows us the market cap of European banks, effectively. That's the red line set against the market cap of Apple. Tech is everything.
Absolutely.
Tech rules everything around me.
I think it speaks for itself, really. So last time the market was fearful appears to be sometime around 2016. So if you look at the last dip here. Now, Apple's market cap then was a mere 0.6 trillion. Now, obviously, it's tipped a trillion. That way overshadows all 26 banks in the Eurostoxx banking index, which is frightening in itself. I think
investors do worry about this concentration of risk in tech firms, right? It wouldn't take much to unsettle the tech sector, and that wouldn't take much to unsettle global markets.
As we've seen recently.
Yeah.
So, tech starts to move, and because it's such a massive part of most indices, it really starts to roll them off as well. And that's really important when it comes to stock selection.
Okay,
now it's really dark.
Now it's really dark. Right.
And here we are.
For you, is this the most chilling chart? This tells us that the Fed has never been able to orchestrate a soft landing, and we're going back in this chart here to 1949.
Yeah.
Why can't it do it, and should we be worried that this time is no different?
If you have a look at the amount of times on this chart that the Fed have managed to orchestrate a soft landing, it is 0. So they haven't. And a soft landing is obviously trying to cool the rate of growth, trying to cool the global economy without causing a recession, and actually return unemployment levels back to the natural rate. we've already seen the stock market, as you mentioned before, start to roll off a little bit, and that is worrying, because that's almost telling us that we know the market is late cycle. Are profits kind of over the peak?
Yeah.
So are companies worried about wages picking up, salaries picking up, inflation therefore picking up, and therefore not being able to afford those workers and being able to afford to deliver those profits going forward? One step.
Okay.
Okay.
Now, if you're worried about the health and well-being of Americans, then this is a scary stat for you. Americans spend $2.6 billion on sweets at Halloween. That can't be good for anybody, right?
Well, apart from the candy companies, of course. Yes, I mean, this is an unbelievable number. So the total of this box is $9 billion on Halloween. Candy, costumes, decorations, and actually, frighteningly, cards. Have you ever received a Halloween card, Katie?
No, nor have I ever sent a Halloween card. How about you?
No, I have not. Maybe we should start.
If we ever find our way out of this mysterious corner of the FT building, maybe we could go and buy some.
Straight to the shop.
Straight to the shop. Laura, thank you.